The Magnificent Seven reported earnings last week. Overall, it was a strong quarter with Microsoft, Alphabet, Amazon, and Apple all beating expectations on the top and bottom line. So, big week. Scott, let's just go through these companies one by one. We'll start with Alphabet. Let's see here. Beat on top and bottom lines. Revenue up 16% to $102 billion. Crushed it on YouTube revenue. Crushed it on search revenue, which actually accelerated. Cloud revenue up 34%. The stock rose 8%. It's up 48% year to date. Best performing big tech stock of the year so far, just as predicted. Your reactions?
The Google Cloud is emerging as the preferred platform for AI workloads. So essentially, the Google Cloud is becoming known as sort of the AI cloud. And over 70% of existing cloud customers now use Google AI products. And the company, their Google Cloud backlog hit $155 billion. That's up 46%, not year on year, quarter on quarter. It was up 82% year on year. Just nothing short of extraordinary here. These are companies well positioned, who's made forward-leaning investments, who have outstanding management. The interesting thing that the team pulled together is they're saying that these firms are flipping from asset light to asset heavy. Essentially, they're becoming utilities of the information age.
That was Scott Galloway and Ed Elson on the Prof G podcast, giving a recent tech market overview at the end of October. Obviously talking about the Magnificent Seven there: Apple, Microsoft, Alphabet, Amazon, Meta, Nvidia, and Tesla, who have collectively added about $6 to $7 trillion in market values since early 2023. That's insane. Nvidia alone ballooned from under 500 billion to 2.3 trillion at its peak. Now, global equities tied to the AI boom include things like semiconductors, cloud, energy, infrastructure, automation. That lifted the total market cap by roughly $17 trillion worldwide. Amazing. Now, get this, AI stocks now make up nearly half of the S&P 500's total weight. I mean, think about everything I've just said there. What could go wrong? Is it a bubble? Let's get into it. Okay, analysts at Macro Strategy Partnership, who are a London-based research firm that tracks global liquidity cycles, call this the largest speculative phase in financial history. They say the AI trade is 17 times bigger than the dot-com bubble and 4 times the scale of the 2008 crash in capital misallocation. Wow. And you know what? I laugh, but maybe it's because I'm nervous, but I think they have a point, right? And I say that because I was looking at OpenAI and I was having a chat with ChatGPT about this, and we were both laughing because it was like, we were both laughing. It's an AI, how's it laughing? But you know what I mean? And it told me basically, look, between its own projects, right, and the investment commitments from Microsoft, SoftBank, Oracle, and others, we're looking at a $1 trillion pipeline of AI-related spending that covers data centers, chips, cloud expansion, technology enhancements, you name it, right? But its forecasted revenue, around 13 billion this year. So that's roughly $75 of capital chasing every $1 of income. That math ain't mathin'. You know, that ratio alone tells you how stretched belief has become, I suppose. Now, I get it, right? There's context, and it's positioning things for future and stuff like that. But on the surface, that's crazy. It's crazy. Even the Bank of England has called this a market built on fragile concentration, which is unsurprising, right? As I said, when AI stocks are now making up nearly half of the S&P 500's weight. And former Biden advisor Jared Bernstein says the clearest bubble signal is simple. When investment outpaces profit by orders of magnitude, 75 times in OpenAI's case, that is the top forming right in front of you. Michael Burry, the investor who predicted the 2008 housing crash, played amazingly by Christian Bale in that incredible movie, The Big Short, has publicly warned that the AI trade looks exactly like a bubble. And he would know, right? This is one of his recent tweets. I'll put it up there. Understating depreciation by extending useful life of assets artificially boosts earnings, one of the more common frauds of the modern era. Massively ramping capex through purchase of NVIDIA chips, servers on a 2 to 3 year product cycle should not result in the extension of useful lives of compute equipment. Yet, this is exactly what all the hyperscalers have done. By my estimates, they will understate depreciation by $176 billion between 2026 and 2028. By 2028, Oracle will overstate earnings 26.9%, Meta by 20.8%, etc. But it gets worse. More detail coming November 25th. Stay tuned. Now, today is Wednesday, the 12th of November. So in 13 days, let's circle back around and see what Michael has in store for us. But in essence, what his posts are saying is he's just calling it what it looks like, right? Money spinning around in a circle. Firms raise capital for AI and invest it into other AI firms whose valuations inflate each other's books. It's not productivity yet. It's it's past the parcel, but not with sweets, but with billions. You know, I'll give you an example of a capital loop, right? Microsoft invests billions into OpenAI. They spend huge portions of that into NVIDIA GPU chips. That drives NVIDIA stock price up, and which boosts market confidence into Microsoft's AI positioning. You know, there's just waves and waves of these beliefs that are providing that momentum to drive value, perceived value, and increased stock prices, right? No, of course, Burry's been early and wrong before. He shorted markets that kept rising, and AI might prove him wrong again. But listen, even when the skeptics start sounding cautious while the banks and billionaires keep doubling down, it really is a reminder that bubbles don't burst when the tech fails. They burst when belief does.
Hey, I had to take a quick stop for a sec, grab some water, and also look after this little guy. She doesn't seem to want to go home. She's been stood outside the office trying to get in. So I let her in. I don't know why she's facing the chair. Maybe she's in a sulk with me. But anyway, let's get on with this and kind of wrap this up. Um, as I draw this to a close, I kind of did some thinking while I was kind of making myself a drink, and quite often when you hear about bubbles, you'll hear the kind of YouTube commentators and market experts will talk about things like history doesn't repeat itself, it rhymes. And in this case, it's going to rhyme quite loudly, I think. We're going to see some repeats of, I guess, cautionary tales that we've witnessed before, be it the kind of fiber laid that nobody used during the 90s, railways paved during that kind of boom. And it might be the case for data centers, as we hyperscale these things, because these centers are like the size of cities. In fact, I was joking with my brother a couple of weeks ago, saying, from space, if these data centers plan out as the way intended and they're kind of positioned from space, it's going to look like the Death Star. The Earth's going to look like the Death Star with all these sort of different data centers. And the question really has to be asked is whether demand matches the dream. Not that I dream about the Death Star, but the dream of this hyperscale and this utility of all these data centers, all these chips, all these things, as well as while the investment comes in. That's going to be huge, really. But moreover, I guess the one thing that I want to sort of say is that it's very easy to treat this like another numbers headline: 7 trillion here, 6 trillion there, and we shouldn't be seduced or charmed by these numbers. These numbers decide really critical things that impact lives. Who gets hired? Who gets fired? Right? Who gets replaced? Who gets left behind? Behind every line of code or data center is a quiet bet that we will be able to automate things faster, make things more efficient, that we can adapt. And these things fundamentally impact lives. If the bet goes wrong, the first thing that goes is the pensions, which means what? People can't retire, or they have to come back into the job market, or worse, and these things matter. And as a society, we need to be aware of these greater impacts. It can't just be seen like, they're in Silicon Valley, miles away or whatever it is. And these things affect me because I don't use any AI. These things do affect us, and they affect all of us for the reasons I've kind of said. That's the story really that's buried behind the stock prices, the valuations, and the ticker symbols. So maybe we're not watching a crash in slow motion per se. Maybe it's a correction before the next phase. Maybe AI will transform the world. I think it certainly will. But bubbles form when belief runs faster than delivery, as I keep saying. The output and the value of these AI systems will be realized, but they need to be realized quicker before this bubble happens, if it pops at all. Over the next year, personally, I think we're going to see some more advancements. I think there's going to be some movers and shakers around this piece. And what I think we're also going to see is probably a surge into what I feel is going to happen is going to be this new economy. If not, it will just be the world's most expensive hallucination, which will be absolutely crazy. Either way, exciting times. Stay informed. I hope you found this valuable. If you did, please like and subscribe. Drop us a comment. Tell me what you thought. And in the meanwhile, be good, be kind, stay human.